Before every major financial collapse, there is a moment when nothing looks wrong. Markets are still open, prices are still moving, experts are still calm. And yet, something underneath has already changed. Not loudly, not dramatically. Quietly, so quietly that most people don't notice it until years later, when they look back and say the same thing they always say. The signs were there. This video is about one of those signs. Not a prediction, not a countdown, but a structural shift that has appeared before every major period of financial instability for more than a century. A signal that doesn't show up in headlines, that isn't discussed on television, that doesn't trend on social media, but is watched closely by large institutions, long-term capital, and the wealthiest investors in the world. Because when this indicator changes direction, history doesn't repeat, but it moves. And recently, that indicator changed. If that immediately makes you uncomfortable, that's a good thing. Not because something terrible must happen, but because discomfort is usually the first response when a familiar story begins to break down. This isn't about fear, it's about structure. And by the end of this documentary, you all understand why some of the smartest money on earth is behaving very differently right now, even while public narratives remain confident. Let's begin with a question that almost nobody asks at the right time. Why do financial crises always seem obvious after they happen? In 1929, leverage and speculation were everywhere. In hindsight. In 2000, valuations were clearly detached, in hindsight. In 2008, debt and housing risk were unsustainable, in hindsight. But before each collapse, confidence was high. People trusted the system. They trusted the numbers. They trusted recent experience. And that's because crashes don't begin with panic. They begin with misplaced confidence. The indicator we're discussing today doesn't measure fear. It measures something more important, where confidence is actually going. Because markets don't break when people are scared. They break when capital quietly decides it would rather be somewhere else. This is the central idea of this documentary. Before every major downturn, there is a measurable shift in how capital prices risk versus safety. Not stocks falling, not unemployment rising, but the relationship between risky assets and protective assets begins to change. When that relationship flips, instability follows. Not immediately, not predictably, but historically, without exception. This is why mainstream commentary often misses it. Because surface-level indicators can still look fine. Growth can continue. Employment can remain strong. Markets can even rise. But underneath, incentives have changed. And incentives move money long before headlines move people. To understand why this matters, we need to step back. Not to 2008, not even to 1929. We need to understand the pattern itself. In the late 19th century, during prolonged economic stagnation, wealthy industrialists didn't rely on speeches or optimism. They watched credit. Specifically, they watched the cost of safety relative to opportunity. When borrowing became more expensive, while safe assets became more attractive, they understood something was wrong beneath the surface. Different era, same behavior. By the 1920s, the instruments had changed. Stocks were booming. Technology was advancing. Productivity was rising. The world felt modern. But beneath the optimism, something subtle began to happen. Money demanded more compensation for risk. Safe assets, government bonds, began attracting quiet demand, not from the public, from those who understood cycles. Months before the crash, the relationship between speculative return and safety compressed. The signal changed, the market followed. This wasn't unique to 1929. In 1987, weeks before Black Monday, capital was already behaving defensively. In 2000, during the height of the dot-com euphoria, risk premiums were quietly shifting. In 2007, before housing collapsed, credit markets were already flashing warnings, long before stocks reacted. Each time, the same story, different language, different assets, same structure. This is the first critical point. The indicator does not tell you when something will happen. It tells you when the system has become fragile. That distinction matters. Fragile systems don't fail immediately. They absorb stress until they don't. So what exactly is this indicator? At its core, it asks one deceptively simple question. Is capital being rewarded more for taking risk or for avoiding it? During healthy expansions, risk pays, equities outperform, credit is cheap, liquidity is abundant. But before every major downturn, that balance begins to reverse. Safety starts to outperform risk, quietly, consistently, persistently, not in one day, not in one headline, over time. This shift doesn't mean collapse is imminent. It means the system's tolerance for error is shrinking. That margin, the margin that absorbs mistakes, begins to disappear, and history shows what happens next. This is why large pools of capital care so deeply about this signal. Not because they know the future, but because they understand risk asymmetry. When upside shrinks and downside grows, behavior changes. Preparation replaces optimism. And this brings us to the present. Because recently this indicator crossed a threshold it has only crossed during past periods of instability. Again, not a prediction, a pattern. You won't hear this discussed openly, because it conflicts with comfortable narratives, because it doesn't fit into sound bites, because it forces questions about sustainability, questions about debt, questions about policy limits, questions about whether growth is being borrowed from the future. This is the moment when skepticism is healthy. So let's be clear, this isn't about secret knowledge. It isn't about hidden plots. It's about incentives. And incentives are shifting. And when indicators like this flip, the most dangerous mistake is expecting history to repeat itself exactly. It never does. What history does is rhyme. The sequence remains, the incentives remain, but the speed and scale change. And today, scale matters more than ever. Historically, after this signal appears, the system moves through stages, not overnight, not predictably, but consistently. The first stage is denial disguised as strength. Markets often continue rising. This confuses people. If something were wrong, they say, prices wouldn't be this high. But that logic misunderstands what prices reflect at this stage. They're not reflecting stability. They're reflecting momentum and liquidity. This has happened every time. Prices peaked after warning signs appeared. Because price is always the last layer to respond. The second stage is liquidity tension. This is where behavior changes quietly. Credit becomes selective. Refinancing grows harder. Risk premiums rise subtly, not panic, preparation. This is where inequality of information matters. Institutions feel it first. They hedge. They rotate. They demand protection. And everyone else dismisses it as noise. Now, here is the key improvement. Let's anchor this once, clearly, without drowning in numbers. What this indicator usually reflects is a shift between risk-free returns and risk-taking returns. When long-duration government bonds, assets designed for protection, not growth, begin outperforming equities on a risk-adjusted basis, capital is telling you something. It's not saying collapse is coming. It's saying caution is being rewarded more than optimism. You can see this alignment across multiple areas. Credit spreads widen even as markets rise. Equity risk premiums compress. Demand for duration increases. No single signal matters. What matters is alignment. And that alignment has appeared before every modern financial crisis. Not as a timer, as a condition. This condition can persist for a long time. Months, sometimes years. Which is why people ignore it until they can't. The third stage is acceleration. Small stresses amplify, a funding issue, a default, a policy misstep. Not catastrophic alone, but dangerous in a fragile system. Today, interconnectedness changes everything. Capital moves globally, debt chains cross borders, confidence travels instantly, fragility spreads faster. This is why timing is so difficult. The indicator doesn't say when, it says margin is gone, and without margin, systems snap rather than bend. Why does this time feel different? Not because history changed, because constraints did. Debt levels are historically high. Policy tools are limited. Demographics are less forgiving. That doesn't guarantee collapse. It reduces flexibility. This is why sophisticated capital watches this signal so closely. Not because they predict disaster, but because it marks transition. From expansion to fragility, from confidence to caution. Crises don't begin because something breaks. Something breaks because the system was already fragile. The indicator doesn't cause instability. It reveals it. And fragility isn't felt evenly. Speculative assets feel it first. Highly leveraged entities feel it next. Households feel it last. Which is why disbelief persists. Now we reach the most important point. This analysis is not about fear. It's about awareness. Markets don't respond to narratives, they respond to incentives, and incentives are shifting. And now one final question. If markets are still efficient, if risk is still being priced correctly, why is capital behaving as if protection matters more than growth? Because money doesn't argue, it adapts, quietly, the way it always does before transitions. The question isn't whether something will break, it's whether we recognize structural change before reaction is forced. History suggests most people don't, and that's why moments like this matter. If you want deeper understanding of economic systems, not headlines, not opinions, subscribe. These are the conversations that matter before they become obvious.